Mohnish, thank you so much for being here. As always, I think this is your 8th or 9th year speaking to our class. We're incredibly grateful, and we can't wait to get started. So with that, let's welcome Mohnish to class.
So, Arvind, it's a pleasure to be here, and I'm surprised every year I actually get invited back. But I'll take that. And just a quick show of hands from the audience. How many of you have participated in this before, or is this your first time? If you attended earlier, just raise your hand.
No, Mohnish, they're all new, so they're not.
Oh, good. So I can repeat all the old jokes. Okay, and then also show of hands, how many of you read that Columbia newsletter article? At least the pertinent pages related to GrafTech. Good, we have a few humans who've done that, which is good. So what I'll do, sorry, go ahead.
No, they've all read it.
Okay, so I'd say, Arvind, if you can maybe mute on your end.
Sure.
And then I'll just go through a monologue, a little bit about GrafTech, and then really from then on we'll open up to questions, and we can discuss GrafTech, or we can discuss whatever else you'd like to, and we can take it from there. So the GrafTech discussion is not really designed to have you go trade the stock or buy the stock or any of that. It's more in the kind of the spirit of Ben Graham, because Ben Graham in his class used to discuss live examples of securities, and of course in his class people used to go out and trade those stocks. But I think one of the negatives of talking about case studies from the past is that there's a selection bias. I can pick businesses where we've had huge home runs and keep patting myself on the back, etc. And so you get distortions, which I don't think are ideal in a learning environment. So I picked GrafTech from a point of view that it's a kind of current position. The current valuation is pretty close to where we bought our position, and a lot of the facts around the situation are current as well. So in investing, because we have, John Templeton says that 1 in 3 times the best securities analyst is going to be wrong. This is a game of probabilities, and I don't know exactly how the future will unfold for GrafTech. I have some maybe perspectives on that, but the kinds of things that can affect the future trajectory of a business are a very wide range. You can have kind of extreme outcomes. I mean, like if you take a company like Johnson & Johnson, who would have thought that talcum powder, which they've sold forever, would have a issue after so many decades of sale, etc. So things come from left field, and or you look at PG&E, the utility in California. People who would have bought the stock 5 years ago, they were buying things that are great for grandmothers and widows to own, and that didn't go exactly that way. In fact, PG&E might have been a stock that or a company at some point that Berkshire Hathaway might have been interested in buying. I don't think they're so interested today, but so I think the future trajectory of businesses is hard to predict, which is why we don't want to own 1 or 2 of them. We want to own a few of them, and GrafTech is particularly interesting because Uh, Arvind's all-time favorite stock since the birth of Christ is IPSCO, because every time I talk to him, he only wants to talk about IPSCO, and he's always been hunting for more IPSCOs, because all he wants to do is he wants to own about 10 IPSCOs in his portfolio, and then ride off into the sunset, and that's all he aspires to do. And so I said, what better than to give Arvind IPSCO 2.0 as a gift for him being a new father and all. And so GrafTech and IPSCO have some similarities. They also have some differences. But just to give you a quick recap on IPSCO, which was in the Columbia newsletter you guys read, is basically at the time, I think in 2003, 2004, when I was looking at it, the stock was in the 40s, and they had about $15 a share in cash, and they had projections for the next 2 years of cash flows of $15 a share each year for the next couple of years. So they made tubular steel, and one of the large kind of applications of their products was in pipelines. So when these kind of pipelines got laid in kind of central US, that's kind of a multi-year project, and they usually would place orders with steel companies like IPSCO to have a certainty of delivery and price and so on. And so IPSCO had this kind of confirmed orders and backlog with confirmed margins, etc. And so it made it pretty easy, where you say, okay, the company has no debt. It's got $15 a share in cash. The next 2 years, $30 a share in cash is going to show up on the balance sheet, and that's $45. I can do the third grade math, and the stock is below 45. And so at that point, the plants, equipment, inventory, know-how, customer relationships, everything is for free. And I thought all those other things have some value at the end of 2 years, maybe not insignificant value. So, but also it's a very cyclical business, where it was entirely possible that after 2 years earnings could be zero, or maybe $5, or maybe negative $5. There was a range of things that could happen after a couple of years, but I thought the risk-reward scenario with IPSCO was very favorable, because you would have all these kind of assets with no debt, and it was highly likely that those assets had real value. In the case of GrafTech, there are some similarities and there are some differences. So one is that GrafTech has backwards integration into the key raw material required to make the ultra high performance electrodes, which is needle coke, and the needle coke captive plant that they have. They're only outside of China. There are only 4 needle coke producers in the world. 2 are in the U.S. And 2 are in Japan, and one of them in the U.S. is GrafTech in Texas, and needle coke, because GrafTech has that backward integration into needle coke, they have 2 advantages with needle coke. One is that they know what their costs are for several years, because they've hedged decant oil, so they pretty much have pretty much a lock on the production cost of needle coke. And the second is they are a low cost producer for needle coke. So, for example, today, if you are a UHP producer, you would be paying like $4,500 to maybe $5,500 per ton for needle coke. And in the case of GrafTech, their production cost, needle coke and everything else that they need to make their electrodes, is $2,750 per ton. So while the other producers might be at maybe, let's say, 6,000 or 7,000 per ton, GrafTech is at 3,000 or 2,700 per ton. That's a pretty significant delta. And they have that delta for about 70% of the production. So if you just look at it very simply, the company has, let's say, maybe around, realistically an ability to produce maybe 180,000 or maybe 190,000 tons of UHP electrodes a year, and approximately 145,000 of that, they have this low cost advantage. Maybe there's about 40,000 tons where they don't have the low cost advantage. Those 40,000 tons, even in today's environment where profits are good for everyone, it's probably like maybe 60 to 80 million in kind of EBITDA type income from that non-captive tonnage, the 30%, and the captive tonnage, which is the 145,000. That's got, before you take out corporate overhead and everything else, you're at 2,750 and you're selling at close to 10,000. So you got close to 7,000. So it's kind of like north of $1 billion in margins, and then you can take out 60, 70 million of overhead and another 60, 70 million of capex, and maybe another similar, maybe 125 million for debt. So you take out about 300 million, you still have about, and then you take out taxes, you still have like 600 million, 600 million coming out of the captive. And that 600 million, probably closer to 600 million, is locked for several years. And basically between, their cash flow in the next 5 years is pretty much approximately equal to the market cap. And so GrafTech has a couple of differences versus IPSCO. One is this advantage which they have with needle coke could extend well beyond 5 years. So if someone were to try to bring in new capacity of needle coke, there are a number of challenges. So one of the challenges is that the last needle coke plant built in the world was actually the GrafTech plant, which was built close to 40 years ago. The know-how to build those plants and run those plants is almost non-existent. Pretty much, I think almost the only players who could even go there might be the existing players. The second is that the time it would take from the time you said, okay, let's go build a plant to the time you have production coming out the other end is close to 7 years. And the cost would be several $100 million. So it's very hard to kind of justify the capital required, let's say 500 million or something, and the gestation period of the 7 years with no crystal ball to tell you what the market looks like 7 years from now. So as far as we know, none of the non-China players, needle coke players, are planning any or have announced any capacity increases or additions. So this tightness with needle coke may continue well past 5 years. In fact, it's 5 years today if someone doesn't announce a plant, or it's 7 years today if someone doesn't do anything for another year. It's another 7 years. It just keeps kind of rolling. So that's actually a significant advantage. The other thing is that needle coke has another application, which is in EV batteries, and that demand is, we all know, skyrocketing. So there could be some substitution effects that come in with EV batteries, et cetera, depending on the pricing, but it could cause significant tightness. We'll have to see. So bottom line is, I think, the bet I made is that we've got a very prudent capital allocator and owner of GrafTech in Brookfield. And Brookfield understands share buybacks very well. They understand capital allocation really well. They own 80% of the stock, and three of their guys are sitting on the board. And so I would expect that the cash flow that comes out of GrafTech in the next few years will have some very efficient usage. Probably most likely a large portion is going to get returned to shareholders because they don't have any other need for the cash unless they go do something interesting. So so it looks like a kind of heads I win, tails I don't lose much. It's the downside is quite well protected. The upside is kind of hard to gauge. We don't know what the upside is. But I think if you can make bets like that where you've covered the floor, like Buffett says, rule number one, don't lose money. Rule number two, don't forget rule number one. I mean, if you can make bets where your downside is covered, that's much of the battle. And such. So it's not a stock tip. I think it was just given really kind of as a kind of contemporary example of a class of investments that doesn't fit the typical mold of typical. Ideally, what we want is long-term compounders. That's what we always want. We want these businesses which have huge runways, which have a flywheel that is hard to penetrate, and they just got like decades of growth ahead. I mean, if I take an example of a company like Costco, for example, they just opened up in China. They opened their first store in China, and the store got mobbed. They couldn't let there were long lines. They just maximized capacity of people trying to get in. And what could the size of Costco's China business be in 20 years? It could be a pretty large number. It could also be a pretty small number. We don't know. I mean, there are uncertainties in business, but if they can make China work, it could dwarf their footprint in the U.S. And how many countries can Costco roll out that model? I mean, they're only in a handful of countries today. So if you look at a business like Costco or a business like Amazon, you can see that there are possibilities of these compounders running for a while. And I think Arvind had mentioned that Jim Sinegal is coming to BC, I think, to see you guys. What a treat, I think you should press him to tell you about the competitive advantages and the moat of Costco, because that's a fascinating discussion. So anyway, those were some of my thoughts on GrafTech, and we can now take the discussion in any direction you'd like to take it. And if you can just introduce yourself and then ask your question, that'd be great. Thank you.
So Mohnish, thank you. That was great. And, we're really excited to explore the point you raised on quality compounders. Maybe we can start with that a little bit, and before we move into Q&A. How do you think about connecting price to the quality compounder and your willingness to pay for that type of business relative to the GrafTechs of the world?
Yeah, and I think that's an area where someone like me is at a big disadvantage and actually repeatedly makes a lot of mistakes, because I'm a cheapskate at the core. And like I think one time Charlie Munger told me that Costco and Walmart had talked about merging a long time ago. Both were much smaller businesses then, and they couldn't come to terms on price. On kind of what would be kind of a fair kind of ratio to combine and so on. And the two walked away. And Charlie said to me that it really did not matter what the deal was. That wouldn't have mattered much. In the end, the pie would have been so much larger. And so what he was saying is that if these two forces had come together, two great cultures had come together, they compete pretty ferociously in the marketplace, and both have extremely unique cultures. And it is very likely you would not have had another entity rise up to challenge them, just like the situation today. Once you get past Costco and Walmart, you don't have another entity which has that level of culture and execution in that space. So basically, both and especially Walmart might have made a lot more money in the absence of a Costco, or if Costco was part of Walmart, and not having to have Sam's Club and Costco would also have been an advantage. But so I think someone like me has a disadvantage because the unwillingness to pay up is a huge disadvantage. Like I'm thinking about this even for Costco. If I look at the stock, it won't look cheap. But if you think creatively about where this company could be in 20 years, it could look very cheap. It could be very cheap under that scenario. But of course, the thing is that you're making assumptions about the growth and the competitive advantage and the culture being intact and all those sorts of things. So someone like me is still trying to learn to pay up, and it's probably worth paying up for the great businesses, especially the ones that have these huge runways ahead. But I think that where I am with my biases, I'm stuck with the businesses that hopefully are great, but they get cheap every once in a while, and then someone like me can pounce on the bandwagon. And then the second thing I've got to learn, which also is difficult for someone like me, is if I buy something at 4 times earnings and it's a compounder, and I wake up after a few years and it's at 30 times earnings, someone like me is going to be looking to sell that. And that may probably be the wrong thing to do. And so there are two lessons that I have yet to learn well, the lesson to pay up and the lesson to hold on. But you guys are young without my biases, so maybe you'll get there.
As you think about this evolution and your willingness to potentially pay up for great businesses, how do you think about the numbers that you're willing to pay for, as you go out a few years? Because you've owned Mautai, for example, and you have owned some of these great businesses in the past. What is the number that you're comfortable with as you begin to explore that piece of yourself?
Well, yeah, like I think Mautai is a very good example. It's the most valued liquor company in the world. I think I bought our position less than 150 RMB per share, maybe about 4 or 5 years ago. It's now at about 1,200 RMB per share. So it's gone up about 8x. Well done, Mohnish. But the problem that Mohnish has is that before it hit 1,000 a share, I was completely out. And I think probably my average selling price of Mautai, I think if I look back, maybe like between 800 and 900 on average, maybe somewhere around there. And so yeah, we captured a 5-6x over 5-6 years, which is pretty good. Um, but Mautai is a business. I can't think of any business with a deeper or stronger moat than Mautai on the planet. I mean, I'd say if you look at Costco versus Mautai, I mean, Costco has to really execute really well every day. Every day when you go in and shop at Costco, uh, you have to be blown away to keep coming back. Mautai is not in that situation. They've got this 1,000-year-old brand, and it's got mystique, it's got uniqueness, it's got a lot of things about premium in people's minds, and it's got this brand that is entrenched in the minds of north of 1 billion people. That's an extremely powerful moat. Um, so yeah, I'm Mohnish Pabrai and I'm an alcoholic, and uh, you know I should have never ever sold Mautai, but here we are in our AA meeting, you know, making the confessions.
Right. So, when I see you at the next meeting, and a few meetings from now, um, how do you think that Monish would have evolved from his learnings from Mautai, and how do you push yourself in this general direction of quality compounders? I don't mean to press you on this. It's such an interesting dichotomy between the pursuit of the PE of ones and the quality compounders, and I just think there's so much learning that happens in which you've done publicly and very
Yeah.
graciously shared with us. So, and I think it's just so important. It's a similar transition to Buffett and Munger, and how you're thinking about that um, is very important, I think, over the fullness of time.
Yeah, no, I agree. I think that in many ways, I would say Guy is light years ahead of me on this. Um, I'll just give you an example. The thing is that if you look at the investment in Fiat Chrysler, um, which Guy cloned from me, uh, I was his unpaid analyst on Fiat Chrysler. I'm still waiting to get paid on that from him, and the check hasn't shown up yet. Um, but anyway, the thing is that uh, the Aquamarine Fund, which Guy runs, let's say I think at the time maybe it was 200 million in assets, and I was trying to get Guy to make a 10% bet on Fiat Chrysler. Um, you know, so he did agree to make the bet, but he stopped at 2 million shares, and so he was buying at about $5 a share, so it was about a $10 million investment that he made, and so it was a 5% bet, $10 million, and what he has done with that bet and what I have done with that bet are somewhat different. So, for example, we both made the bet in 2012. In his case, he bought 2 million shares. In my case, I bought almost 12 million shares, even though I wasn't running 6 times the capital he was running. I made a full 10% bet on that. And today, after like 7.5 years, he has not touched that position. It's still sitting at 2 million shares. But another thing that happened with him over this period is they spun out Ferrari, and for every 10 shares of Fiat Chrysler you owned, you got a share of Ferrari. And if there's a moat that compares to Mautai, not quite there, but I would say Ferrari's moat is up there. It's one of the most recognized brands in the world, and in a 70-plus year history, they've never placed an ad. They've never spent $1 on advertising, which is remarkable. But anyway, so he got gifted 200,000 shares of Ferrari, which are now, I don't know, $165 a share or so. So I don't know, that's like 33 million. Okay, so he made a $10 million investment. The Ferrari position is worth about 33 million. And the Fiat position, which is after the spin out, they had a dividend. So let's say it's about $18 or $19 a share. It's almost 4x. So you're looking at like a 70 million valuation of Fiat Chrysler and Ferrari combined on the $10 million bet that I did all the work on. No check has shown up yet. And Guy is right now at a Vipassana retreat, trying to learn what Buddha meant by the meaning of life. Hopefully he will understand that he owes Mohnish big time. But anyway, so what I'm saying is that, Fiat Chrysler is not a compounder in the traditional sense of the word. It could be a compounder if you kind of put on somewhat different glasses and look at it, because it does have a good capital allocator, it does have great governance, it had great management, a lot of different things that are very good about it. But Ferrari is clearly a compounder, and it was obvious to me that Ferrari is a compounder. But a lot of the Ferrari shares I got, in fact, when the spin out happened, the Ferrari shares were at about $45 a share, $45 or $50 a share. And in moments, in Mohnish's, moments of brilliance, I thought $50 a share is a full price for Ferrari. It's fully priced. It's more than three times that price. So I sold some Ferrari at 50, 60, 100, 120, etc. I think I ended up making about $100 million on Ferrari. But if I had been as smart as Guy, the 70 million would be, about 3.3 times. So it'd be about 220 million just in Ferrari stock. And it'd be about 150 million just in gains on Ferrari, right? So you look at Mautai, and, I look at it from the sidelines with the occasional tear in my eye. And I look at Ferrari and with more than an occasional tear in my eye. And but we live and learn. So as these things keep happening, Mohnish is getting slightly more educated each time. And but I'll give you an example. I mean, I don't want to really talk about this much, but recently we bought Micron, and I do think actually Micron is a compounder. People don't actually understand the business, and so I'm thinking that God must really love Mohnish, because he gives Mohnish Mautai, and then Mohnish is too dumb to keep it. Then he gives Mohnish Ferrari, and he's again too dumb to keep it. And then he says, okay, I'm going to try again. He gives me Mautai. And this time, Arvind, I'm going to really try to hold on. Even when it gets to 4 or 5 times the current value, we'll try to hold on. And we'll see where we can go with that. But yeah, it's hard. What can I say? These are very, very tough things. They're very hard things for me. Holding Ferrari at $165 a share is a very hard thing for Mohnish. And holding Mautai at 1,200 RMB is a very hard thing for Mohnish.
Yeah, no, that was really interesting, Mohnish. Thanks for that.
But Arvind, keep bringing it up. Maybe it'll sink in a little bit.
Yeah, no, commitment biases can be really powerful, and so I think that's really interesting. Maybe we can open it up for questions. I don't know if anyone has any questions on this topic. If they do, I welcome it. Yeah.
Okay, Matt, I have a question about Micron specifically now that you brought it up. How do you evaluate a company with so many, there's so many things on the horizon, like cyclicality, there's Chinese implications, China's trying to get out of US semiconductors. So it's hard to look at a 5-year future and beyond, I'd say, for this company. So I'm just what's your process when you look at something like that? There's so many different things up in the air.
Yeah, so I'm going to duck all Micron questions. I shouldn't have even brought it up. But I'm gonna duck the Micron questions, maybe for a few years, hopefully. At some point, I hope we can talk about it. But I don't want, like I said, I think generally I always think, Arvind, we don't really want to talk about portfolio positions. Yes. We already opened up the box a little bit with GrafTech, but I think my interest was because Arvind is so eager about IPSCO. Now he's so eager with the compounders that IPSCO has just been discarded. Like, he's not interested in IPSCO no more. You know
why? That's interesting. Yeah,
he loves Mautai.
No, I love the PE of once. I love the PE of once. So I think.
So the PE of ones, long live the PE of ones, man. The PE of ones is where it's at. Now, what we really want to do when I grow up, I want to buy Mautai at a PE of 1.
Right.
And keep it when it's at a PE of 100.
Right.
And when the E goes to 50 to 1 or 70 to 1, and the earnings have grown 20 or 30x, and I'm about to go to my grave, it's still there in the portfolio. I don't know whether I can get there in this lifetime, but I will try.
There's always the next lifetime. Mautai will still be there.
Absolutely. But if the gentleman who had the Micron question, if he has another question, so he doesn't lose his shot at the question, I'm happy to take another question if you have one.
Sure. I mean, yeah. More of a basic question about. Obviously, we read your book about Papa Patel, and you say frequently to make bets where you don't lose much, then you have a really high upside. But it was just strange to me that he risked kind of everything he had, and everything that he risked a lot of what his relatives had. So, how could you say? I know you spoke how he could get back on his feet quickly, but it's hard. How do you make a bet that's not really risking much in the monetary sense, but it could be risking a lot, say, for your net worth?
Arvind, can you just repeat that, because I didn't get all of it?
So I'll repeat the question, and if I'm off, please correct me. Yeah. So I think he's trying to better understand heads I win, tails I don't lose much, and how you come up with bets in that sort of line of thinking.
Well, I mean, I think that the heads I win, tails I don't lose much comes up. I think you ideally want that in every investment. Your downside protection is fundamental. I think just core to any investment. Um, in some cases, like IPSCO, it's very obvious that you have downside protection. I also felt when we were making the Fiat Chrysler bet that we had a lot of downside protection because at the time they pretty much got all of Chrysler for free, which included Jeep and Ram and everything. I read the UAW contract, the new UAW contract in 2009 when they were in bankruptcy, and that's better than Shakespeare, you know. And it's the funny thing is that every 5 years, the UAW. I'll just digress for a second, but every 5 years, the UAW renegotiates contracts with the big three, and it's a kind of a it's a battle. They threaten to strike. We just had the longest strike in 40 years, almost 50 years at GM. In 2009, the Auto Task Force, which was part of the Treasury Department in DC, they went to Detroit, like three of them for a day, to kind of look at the different plants and meet some of the leaders. And they had a meeting with the UAW leadership, and that meeting started at 4 o'clock, and their plane was going to leave at 5 o'clock. So they told the UAW leadership that, listen, we've got a new contract for you, and here's the new contract, and this is where you sign this contract. And the leadership at UAW said, you don't understand how things work in Detroit. You give us this contract, we will review it. It might take a few weeks, and then we'll get back to you, and it's highly unlikely large portions of it will be acceptable to us. And that's how we work things. So the Steve Ratner, who was part of the task force, told the union leadership, he said, look, my plane leaves at 5 o'clock. If by 4:45 I don't have a signed contract, then tomorrow I shut down all the lights in the city of Detroit. I don't particularly care whether we ever make another car or not. So that contract was signed in 20 minutes. And that's the contract I read. And it was beautiful. So the only time when that contract was done that way. So Detroit went from being one of the worst places on the planet to build a car to just after that contract got signed to being the best place on the planet to build a car. It became more competitive. In fact, the Koreans have told me that they'd rather manufacture in Detroit than in Busan in Korea. It's a lot cheaper. So anyway, the thing is that Fiat actually had a bunch of competitive advantages at that time that were not visible, like the redone UAW contracts and so on. So I mean, I think the thing is that we really want to focus on minimizing the downside. I think that when we look at businesses, and that is one of the things that becomes hard for me, when I look at a business like Amazon, which is such an incredible business with such incredible leadership and management, just incredible moats around their business, the downside is where I stumble. I mean, when you look at great brands, the value is intangible. It's not like IPSCO. You can look at the balance sheet, or you can look at contracts, and you can look at guaranteed cash flows coming in. It's a lot harder. So there you have to have a leap of faith on the value of the brands and the moat and such. So that's what makes it harder. But the thing about investing is that even if someone like Warren Buffett has a Swiss Army knife kind of approach to investing. He's had so much experience in so many different scenarios and asset classes and such that he can make it happen so that Berkshire continues to build value in a variety of different structures. So, Occidental is buying something, they do a $10 billion financing, 8% coupon with a bunch of warrants. It's like what they did in 2009. So those are tremendous deals. But if you're an investor, for most of us, when we start out, and even through most of our lives, we may never develop a Swiss Army knife. We may only have one or two or three tricks in our bag. And even if you have just one trick in your bag, that is more than enough to become extremely wealthy. So you do not need, I always give the example of Charlie Munger's friend, John Arriaga, who's a billionaire, and he's a real estate developer. And all his real estate ventures have been within 5 miles of the Stanford campus. He's never gone outside real estate. He's not gone outside of Northern California, not even outside of just the core area around Stanford. And so his circle of competence is just extremely tiny, just probably the tiniest circle you can think of. But that did not stop him from becoming one of the wealthiest people on the planet. So you don't need to, so probably 99.999% of great investments are outside the competence of John Arriaga. He's, if anything is not in real estate, he's going to take a pass. If anything is not even just in that particular geography of real estate, he's going to take a pass. And even in that geography, he's been very disciplined, where when the market got extremely bearish and vacancies went high, he went and bought a whole bunch of stuff. And when things were cresting, that's when he would, at very low cap rates, basically get rid of a lot of stuff and so on. And he just played that game just perfectly. So I think that the key is, stay within your circle of competence. Do not have envy for your neighbor, your idiot neighbor who's making money hands over fists without having any brains. Envy is really bad, but having envy of that type is very detrimental to your financial health. And be patient. So, just sticking to a circle of competence and being very patient, two of the strongest skills that you can bring to bear. You don't even need a high IQ. You can give away IQ points and get more patience genes and get more stick to circle of competence genes. And that's the holy grail.
So my name is Andrew Hickey. My question has to do with kind of career and investing and balance. Do you believe that you can have a career that you're very passionate in and still have the time to be a successful investor looking for PEs of 1 and doing all the necessary research and digging that requires?
Yeah, so I guess what implicit in your question is that your career is not an investing career.
Correct.
Like your job is in some other area, right?
Yeah, sure. Yeah.
Yeah, I mean that's how I started out. I was running my IT company and I was probably spending 15, 20 hours a week on investments, and it was fine. I think that the key is that, how much passion do you have for it? I have a former college roommate he's a radiation oncologist. And he's an extremely good investor, done really well, to the point that even though he makes like $1 million a year as an oncologist, it's dwarfed by the wealth he's built on the investing side, because he's done so well on the investing side. So at this point, I always tell him that, hey, isn't oncology a hobby? He says, yeah, Mohnish, it's been a hobby for a long time, and and uh, and so definitely, I think that, in fact, in some ways, it could be an advantage um, to be a part-time investor because the key is uh, if you become like Guy Spear, basically comatose as far as trading goes, um, generally that'll be good for your financial health. And so if you were a part-time guy and you just said, listen, I just want to focus on maybe finding on average one investment a year, or a couple of investments every couple of years type thing, that's more than enough. You don't need many investments to do well. And so absolutely, I think the important thing is that you have to have a passion for it. You have to have a drive for it. I mean, it's something that needs to really excite you. And if that is the case, then anything you're generally passionate about, uh, you will generally do well. So no problem. And again, the thing is that you can be like John Arriaga. You can find a particular niche that appeals to you, and just hone in on that. And so you don't need to know everything about everything. I think, in fact, you can become very specialized in particular areas of investing, and that can be more than enough.
I saw a bunch of hands. Yeah, please. Yeah.
Can you hear me from here, or should I go up there?
No, you're very clear. Go ahead.
Yeah. Brian Regan. I'm more interested in mistakes that have happened in the past, and I thought it was interesting in your book. When you were giving the example of intrinsic value, you talked about Bed Bath & Beyond, which at the time was trading at $11 billion, and I looked at it now, and it's at $1.4 billion market cap. And you didn't recommend it in your book. I just think it's interesting how far it's fallen. So like evaluating mistakes where that might have seemed kind of investable at the time of your book, or at least fair value, and how much of a disaster it's become, and how to avoid those. And also, like, how do you recognize the mistake and trade out of it?
Yeah. What do you know the name of the company you read about?
Bed Bath and Beyond.
Yeah.
Oh, Bed Bath & Beyond. Yeah. Actually, Bed Bath & Beyond is a business I never invested in. And I think I actually used it as an example of a company not to invest in. I have to go back and look at but I've never made an investment. I hate retail, and so it keeps me out of trouble to. But I would say this, that mistakes are very much part of the game, and like for example, one of my mistakes which went to zero. I've had a few zeros. So one of the zeros was a company named Horsehead Holdings. It's a company in Pittsburgh, which was a zinc processor, and they went bankrupt, went to zero, etc. It was a significant loss because we had quite a gain for a while, and then it went the other way. And I wrote about Horsehead probably more than I should have in my letters to investors and in the annual meetings I had. I spent a lot of time explaining to my investors about Horsehead. And I think in one particular letter, I went on and on about, the mistake and so on. And there's been only one time in my life when Charlie Munger has called me, and I remember I was at Kennedy Airport, and I was at the JetBlue terminal, and I was about to take a flight back to LA, and the phone rings, and Charlie's assistant is on the line saying, "Mr. Munger would like to talk to you." Okay, so I said, "Oh shit, what did I do wrong?" You know. So I, I, I think they were boarding, but I said, "Okay, well, let's find a quiet place to uh, talk to Charlie." So I, 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 I told her, yeah, that's great. So anyway, he came on the line, and he said to me that he read my letter, and he said, Monish, you want to learn from your mistakes, but you don't want to learn too much, and you have to move on, and you have to move on quickly. And his concern, it was really, I think I was very touched because his concern was, whether my mind was being messed with, you know. Um, and actually, if you, I think recently there was a letter written by, I think it's Wedgwood Partners, where these guys had been very long-term holders of Berkshire Hathaway, and they wrote a letter in which they gave a long list of reasons of why they've unloaded their Berkshire position. How many of you have seen that letter? Okay, so anyway, you can just go to God Google and say Wedgwood Partners Berkshire Hathaway, and God Google will pop up that letter for you, and it'll show you all the different things that they said in that letter that Warren has done wrong. So they were saying, look, we've had this massive bull market in the last 10 years, and you bought IBM, and that didn't work well. And you bought Precision Castparts, and that didn't work well. And you bought Lubrizol, and that didn't work well. And then you bought Apple, but you didn't buy enough. And then you should have bought Microsoft, and for whatever reason, I mean, Microsoft, Warren has said he can't buy it because of his friendship with Bill Gates. But Bill so well, and you know Microsoft so well, and that's done so well, it's not in the portfolio. And you guys knew that Google was great because the founders came to you, on and on. The guy listed a whole bunch of mistakes of Warren Buffett, right? And actually, if you look at the Berkshire, and I pointed this out in the Columbia interview, that if every Berkshire acquisition were equal weighted, they have a very large number of mistakes. I mean, almost all their retail investments, other than Borsheims and Nebraska Furniture Mart, didn't work, and there are dozens of them. So the thing is that if you equal weight them, the record isn't great, but the reality is they're not equal weighted. And he's been right on the big ones. And so when you dollar weight it, the record is great. And so we are human, and Warren Buffett is not. Okay, and God makes a lot of mistakes. And God's first apostle, also known as Charlie, called from the heavens and said, "It's okay. It's okay. Don't beat yourself up too much, because mistakes are par for the course. Even God makes them." And so the thing is, that's why Templeton said that you can have a phenomenal record even being wrong 1 out of 3 times. And so in the investing business, mistakes are par for the course. There are going to be plenty of mistakes. And I think I really got a lot out of the Munger phone call, because basically, because we are humans and we like to analyze and we like to get better, you can get into a tailspin where you're trying to learn too much from the mistakes. And there are scenarios under which we can lose money on GrafTech. There are scenarios under which GrafTech can go to zero. There are many things that can happen which can destroy the thesis. That doesn't mean it's a bad investment. So there are businesses where you could make 10 times your money, and it would not have been a prudent investment. And there are businesses that you would have lost a lot of money, and it was absolutely correct to make the investment. So it's a game of probabilities, and I think as long as we have, done our homework and try to assess the probabilities correctly, you cannot always tell the score by what's on the board. You have to go deeper than that to tell the score. And so I think mistakes are inevitable in investing. They're going to happen. I mean, even if you look at the book like Good to Great, all those companies went AWOL. They were all touted as great businesses, and they all faltered, or most of them faltered. And that's the nature of capitalism. I mean, that's one of the reasons that keeps me away from the compounders, is because almost no businesses survive for 30 years. If you extend that to 50 years, it becomes an even smaller number. And how many businesses have been great compounders for 100 years? Well, GE is, I think, the only one that's been around for that long, and look where they're at, And so when you're trying to go through these kind of long runways, the history of long runways isn't that great. I mean, I can't point to 10 businesses which have done really well for 100 years on the planet. I couldn't come up with a list like that. And so that tells you that there are very strong forces in capitalism with creative destruction which take the mighty down. And such. So that's one of the things that kind of goes on in my head about, what can go wrong is, and probably I'm overdosed on the mighty going down, and probably need to temper that back a little bit. But that's where that is, and mistakes are our friend. We want to learn, but don't learn too much. Next question.
Mohnish, how do you make, that was just a very interesting response. How do you balance learning but not learning too much? How do you find the right balance there from your mistakes?
So I think, I spent a lot of time thinking about what Charlie said, because my phone call with Charlie, the phone calls with God are only 2 or 3 minutes long.
Right.
God's got a few things going on. But I spent a lot of time thinking about those 2 or 3 minutes. And I mean, I think the most important thing is it can't mess with your brain. You can't get it into your head, where it takes control. So what I'm saying is that mistakes are going to happen. We want to learn from them. We want to keep getting better. But you have to keep playing the game. And you have to keep moving on. So if it's stopping you from moving on, I mean, I can tell you very directly, for example, that since Guy is not in the room, we can beat up on him some, especially since he hasn't paid yet. But Guy went long horsehead, and it actually, I think it messed with his head, because he was then very deeply involved in the bankruptcy proceedings and on the creditors committees and all of that. And I kept trying to tell him through that entire process that it's not worth it. Move on. There's none of these things that because the enormous amount of time, and actually there were no recovery. So actually it was a total waste of time to do all of that. But one thing he would point to very directly is, while all that was going on, while he was completely focused on Horsehead after it had gone to zero and in bankruptcy, is I brought up Mautai to him. And I tried to get through, but his brain was completely on Horsehead. And so I kept telling him, Guy, Mautai. And he's saying, Mao what? And I said, Mao Tai. And I couldn't get past, right? And I think he made, I don't know, maybe $100,000 investment in Mao Tai or something. It's a very, very tiny investment, irrelevant, basically, couldn't make any dent to the portfolio. And in 2017, Guy, me, and my daughter went to Mao Tai headquarters. We made a field trip. Okay. By that time, it was already at about 600 RMB, so he thought it's all over. And then he had such deep regrets. And of course, I didn't want him to ever forget those regrets. So I spent the entire trip just telling him, Guy, do you remember all those phone calls and all those conversations where I tried to talk to you? I would try to shake you up. And I said, you are a compounder guy. And I bring up all crappy businesses to you. Here I am bringing you a great compounder and the greatest of all compounders. And I couldn't get through. And of course, that really irritated him, because what he wants to do is he now tells me I should have just bought 10% of my fund in Mao Tai, and I should have just kept it till the day I die. Very simple. I know that if he had bought it, unlike me, he wouldn't have sold it, right? Because he's got superior genetics on that front. But the thing is that he has inferior genetics on seeing the diamond in the rough, right? So anyway, that's the way life is. But yeah, I mean, I think that learn but don't learn too much. We let you fill in the blanks of how to figure that out.
Wonderful. Other questions? Yeah.
Hi, Chris Kern. So my question kind of pigtails off that. So it seems like you're a great friend to Guy, giving him tips on Fiat and Mao Tai. And I think from the article we read, I believe it was GrafTech, you actually got the tip from someone that wrote into you and gave you a tip. So I'm curious about kind of the process you go through vetting some of those, and then also how much the check that you wrote to that individual was.
So first of all, let the record reflect that I called Guy not once. I brought up GrafTech to him on at least 10 different occasions. And I've tried to have very long conversations with him. And I sent him that write-up and many other write-ups. And his total investment in GrafTech currently, to the best of my knowledge, is zero. It's even less than the Mao Tai investment. So I just want for permanent posterity, for the record to reflect while Guy is in the Vipassana retreat, that his GrafTech position is at zero. So the individual in Canada who brought it up to me has not been paid yet by me. I do owe him a meal. I do need to take him for a meal. So next time maybe I'm in Toronto, I'll take him out and we'll take it from there. But yeah, I am the shameless cloner, and I am in desperate need of your ideas. So mp@pabraifunds.com. Please send me more Mao Tais and more IPSCOs and more compounders. Thank you.
Other questions? I saw a few hands in the front. Yeah, go. Okay.
Yeah, good. The black back row got the message, come on in the front.
Hey, Mohnish, I'm Cameron. So earlier you were kind of talking about shifting to quality compounders, and then we started talking about kind of how the mighty fall. So made me kind of think, do you have a process for differentiating between quality compounders and kind of undisciplined growth? And how do you go about separating those?
Yeah, that's a good question. So actually the thing is that you can almost take this as a law of physics that pretty much every company in existence today will eventually be a zero. It'll disappear. I mean, I already told you, if you go to the New York Stock Exchange, look at companies over the last 100 years, kind of one has survived that period and they were kicked out. I think GE is out of the index now. I mean, I think the record is a 100% record that you can take it to the bank that businesses being around 50 years from now. I mean, I would say you can make a guess that Mautai may be around 50 years from now. That's a pretty good bet to make. But I would say if I look at a business like Costco, I don't know if 50 years from now they are still cranking. Cultures can erode. Managements change, cultures erode. 50 years is a long time in retail. So I think that's where the difficulty comes in is, and the other thing that can happen is that they can get into trouble. I mean, if you look at a company like Geico, it's been around since the 1930s, but it was on its knees in the 70s. Would have gone bankrupt if the regulators weren't benevolent as they were, and Buffett didn't step in and so on. So you see a lot of history where great brands get into trouble, and some of them may come out the other end, and some of them may not. So I think that's the difficulty, is that it's not just unconstrained growth. I think that it's that capitalism is extremely brutal. The competitive forces that work on a business every day are very intense, and there's a very small sliver of businesses that can withstand that continuous badgering for decades. I mean, if you look at a business like MasterCard, very dominant. Are they around 50 years from now? I don't know whether I can make that bet. Payment space has got a lot of competition, a lot of things going on. People bring up American Express all the time to Buffett and Munger. Every time they question the moat. And Buffett and Munger's response has always been that they don't see issues with the moat. And they're happy to hold. And actually the numbers so far support them. And in fact, I was just reading recently that the Centurion card by American Express used to have a $2,500 annual fee. They just bumped it up to $5,000. And it used to have a $5,000 initiation fee. And they just bumped that up to $10,000. And they increased some benefits. I mean, I think that's an incredible franchise. They have no competition in that space. At the very top end, when people are paying them $10,000 a year or $5,000 a year to carry the card, it's quite an incredible moat and such. So I mean, I think that these are difficult. Like what Charlie says. Why should it be easy to get rich? Why should it be easy for us to figure out which compounders will get us 20x with very muted downside, and which compounders are we going to lose our shirt on? That is an extremely hard question to answer. I don't have the answers. I mean, things can come out of left field, and but that's what makes this fun. And that's also a reason why you want to have more than one stock.
Other questions? Yeah.
Sure. My name is Eddie Walsh. Thank you again. In considering from your book, Mittal Steel Mills, Mr. Mittal, might be pronouncing that correctly, it's clear that those were distressed assets that had significant upside potential and limited downside, since you basically got many of them for free. But I think something that maybe I missed is how did he operationally turn those around? Like, how did he realize the upside potential? And ultimately, that's kind of from the operator's perspective. And then separately, as an investor, how do you kind of look at a situation like that from the outside, where you're reliant so much on management's ability to accomplish an objective?
I'm sorry, which example in the book were you referring to?
It's MITTAL, when he had the steel mills.
Oh, Mittal, yeah, sure. Yeah, I mean, I think that, well, Lakshmi Mittal, I think you could have looked at a very long history where if you just looked at his trajectory of he repeatedly bought very distressed assets. And there's a company now, I talked about this, if you look at YouTube, video of mine where I spoke to Peking University, I spoke about a company in India called Motherson Sumi, which basically rolls up auto parts companies. So I think the Mittal culture, and I think to a large extent, a lot of that was present in Fiat Chrysler, in 2012, it was very clear to me when I was making that investment in 2012 that Sergio Marchionne, the CEO of Fiat Chrysler, was an extremely unusual human being, an extremely unusual manager. And there had already been Harvard case studies on him before I'd invested. And there was an 8-year history of him in the auto business from 2004 onwards. I mean, I think that Fiat was losing, I think, more than 100 million a month, maybe 150 million a month when he came in. And they were upside down, the capital was gone, the banks were on their throats. And in that environment, he got them to the promised land and then some, and then orchestrated the Chrysler deal and so on. So there was a lot of historical trademarks we could look at. If you study the guy and you just look at my video on Motherson Sumi, he's got a flywheel which is very unusual in the sense that Motherson Sumi never reaches out to a company to acquire them. And they never answer the phone when a company wants to be acquired. The only time they really kind of start moving is when one of the large OEMs contacts them and says, like BMW contact them and say, look, this company that makes rear view mirrors for the 7 Series is losing $2 million a month. And we're afraid they're going to go under. And our second source doesn't have the capacity or whatever else. And can you take them over? And at that point, what the Motherson guy says is, he'll tell BMW, okay, of course I'm here to service you. How much are you going to pay me to take over the business? So a lot of their deals, they get paid to take over the business. They're not paying to buy the business. And over a, 25, 30-year period, he's compounded at 30% a year in the stupid auto parts business. So if you look at someone like, Chan Sehgal at Motherson Sumi, I think Peter Drucker said that culture eats strategy for breakfast. So Motherson has a very unusual culture of how they do things. For example, they've never relocated a plant to China for labor advantage. If they buy a plant in Germany, they keep it there. They've never injected their people into those plants. They've actually fired the top guy always, but then found someone young, maybe even 3 or 4 levels down, a 35-year-old they put in charge of the plant. So they've just got a number of kind of, and they might get paid 50 million or 75 million to take over this mirror manufacturer, which gives them a 2-year, 3-year runway to fix the company. In 3 months, the company is going to stop losing money. And in 6 months, it's probably going to start making money. And about a year or 18 months, they're making 3 million a month. They've completely flipped it around. So I think that you can, the way Buffett and Munger talk about it is that they don't have put any faith in projections. They look at the track record. And when you're looking at these investments, when you look at ArcelorMittal or Lakshmi Mittal or Sergio Marchionne or Chan Sehgal or any of these guys, at MasterCard, we have Ajay Banga. You can look at his track record at Citibank and other places before. He's just an incredible executor. So many times the record is obvious. I would say that, Fiat Chrysler is now going through a possible merger with Peugeot, PSA. The guy who runs PSA, Carlos Tavares, is like Sergio. I mean, incredible record. This amazing record, amazing execution, proven it over and over for decades. So you've got a rock star, and the odds are that rock star will make things work because he's made it work so many times in the past, and he's never failed in the past in any major way. So I think the key is look at the. So many times we don't have enough of a trademark on a manager where we can't tell. We can always take a pass, but plenty of times we do have trademarks, and we do have a lot of history, and we can look at that history. One of the things about Jim Collins is he talks about level 5 leaders. And you can look at those traits. What are the traits that make a level 5 leader? And you can pretty clearly tell, is the guy high ego or low ego? The best leaders are ambitious, but they're not ambitious for themselves. They're ambitious for the organization. They want the organization to be a rock star. They don't want them. So, for example, before your time, there was a guy named Al Dunlap, Chainsaw Al, who took over Sunbeam and whatever, and everything blew up in spectacular manner. There's a number of leaders who appear to be good, but the egos are very high for themselves. That's not a level 5 leader. So you can run a test on the different traits. Servant leadership is another trait. And if you read Phil Fisher's book, he goes into a number of traits of great leaders. So I think you can look for those traits, and it becomes obvious. Like Carlos Tavares, all his suits are off the rack, no custom suits for him. The guy loves to travel coach. All his peers are doing private jets. And when he goes visits a plant, he gets lunch himself at a local deli, some sandwich, and then goes in. So he can squeeze blood out of a rock. Okay, so for 20 years, GM, multiple different managers went to Europe to try to fix GM Europe. They continuously lost money for 20 years, and finally, they paid him to take the business. And in 9 months, they were making money. So the same unions, all the same nuances of Europe, he made it work. And they're making, I think GM Europe is making north of $1 million a year. I mean, $1 billion a year. It's a very profitable business now. And GM was happy to get rid of it for nothing. So what's the difference? The only difference is that Carlos came in. That's it. And then Carlos put his frameworks to work. And the same people, same everything, the business is humming. Next question.
Yeah.
Hi, Mohnish. My name is Ramsey. I had a quick question. I read in the Columbia interview that you had seen some interesting opportunities in Turkey, and I know you said an investor should ignore the macro picture, but how do you feel investing in a country where the institutions of the government are deteriorating significantly?
Yeah, so the thing is, I grew up in India at the time when it was very heavily socialist, very anti-entrepreneur. But if you own the Coke bottler in India, you do just fine. Okay. So I would say that in any country in the world, if you own the Coke bottler or the Pepsi bottler, probably a good business. Okay. So if you own the dominant credit rating agency, probably a good business. So what I'm saying is that there are businesses that transcend geography. Okay. And they transcend currency. So, for example, let's say some country has crazy inflation. If you're the Coke bottler, it doesn't matter. You'll still get paid. You'll get a margin. They could use seashells for currency. It would still work. You're gonna, so the thing is that people will be willing to trade certain amount of their labor for a Coke. That trade will happen, no matter what. So when I looked at Turkey, I was mainly interested in these, what I would call bulletproof businesses. I wasn't interested in, so there are, the good news with the internet and YouTube and everything is there are fans of Mohnish globally. And there are fans of Mohnish in Turkey. And the interesting thing about these fans of Mohnish is, like the one guy who's my good buddy in Turkey, he's overdosed on Graham and Buffett and Munger before I ever met him. The guy is, he's already completely well-trained, well-trained and a friend of Mohnish, and offering services for free. Like I tell these guys, listen, is it okay if I visit Istanbul and can we just go meet all the companies in your portfolio? And is it okay if I buy them if I like them? Oh yeah, it'd be so good. It'd be great to hang out with you. Okay. And I said, do you want to get paid? Oh, why do you embarrass me? And I do try to pay them, but I'm usually unsuccessful. So they're completely immersed in Graham and Munger and Buffett, well-trained. If a person has overdosed on Buffett and Munger, generally speaking, they're a high-quality human being, because that means they've generally picked up some finer skills in terms of the soft human skills, and they generally are going to be honest, high-quality people, and that's what I found. So I like my buddy in Turkey, and the problem my buddy in Turkey had was that he overdosed on Graham, and he underdosed on Fisher. And so I told him, listen, can we not go see the PE of ones in Turkey? And can we go meet the Coke bottlers in Turkey? Please. Because he was showing me PE of 0.1. Forget PE of 1. He was showing me PE of 0.1. I don't know, Arvind's probably orgasmic at this point. But I told him, I don't want to see the PE of 0.1s. okay? Please, because I know that there's going to be hair on them that I won't be able to deal with, you know. So I said, it's okay to pay 3 times earnings for a Coke bottler. Let's go meet those guys, you know. And so that's what we did. I focused, and he's, you know, he's so deeply into Graham with all this PE 0.1 stuff. And it's so great when you have that whole portfolio of those businesses, but he's moving. The good news with him is that he has seen the light. One of the things that took me a long time to figure out is you don't want to focus on discounted pies. Discounted pies are okay. What you really want are growing pies. Because growing pies is really where the Holy Grail is. And so I tried to tell my friend in Turkey, listen, please, the growing pies and the great pies, you know, not the ones that have been stale and sitting for 2 days. So I think that you can go to Turkey, no problem. And you can go to, I mean, the same thing, I think the same thing in South Korea. There's my buddy in South Korea, completely trained in the ways of Graham and Buffett and Munger, etc. Again, the problem with these guys is because these are cheap markets, they overdose on the cheap stuff. The Turkish guy and the South Korean guy are both overdosed on Graham. And so I worked on both of them. And I think they have some, they are happier for those lessons. And of course, the thing is that, you know, when we are sitting by the seaside next to the Bosphorus, having great seafood for dinner with, you know, fresh grilled Mediterranean sea bass coming to you, you know, and then we're talking about the switch from Graham to Munger. All of it goes down really well. So it's awesome. In fact, I have a trip coming up now to South Korea in early December. And, you know, this will be my 3rd trip. So I told the guy, listen, I know you took me to all these cheap companies and I was trying to get you to make me see the good companies. This time, it is only great businesses. We're not seeing any Mickey Mouse 0.1, PE of 0.1 or PE of 1. I'm looking at the great businesses. And because the market is so cheap, they are still available at great prices. So that's okay. Next question.
Right. So Mohnish, on that subject, as you're looking for these great businesses,
I knew Arvind, the 0.1 would get your attention.
no, it's not. It's not the 0.1. I think the goal is really to get a great business at a great price. That anomaly, you know. And so, you know, as you're thinking about that, or you know, in different markets, how are you balancing, you know, the price relative to the business quality? Because functionally, you know, you gave the example of buying the Coke bottler at 3 times earnings. You know, that's much better than buying at surface value a crappy discounted business where the pie isn't growing at 1 times earnings. So
Yeah.
how, you know, how do you are you know, are you really seeing them at 3 times earnings at that in those types of markets, and how do you balance that?
I have
Yeah.
not yet found a Coke bottler at 3 times earnings, but the
Right.
hunt is on. Okay.
Right.
But I would say this, that both, well, Turkey and South Korea are both interesting because I like South Korea better because Turkey is a lot more discounted pies and South Korea is a lot more growing pies in general. If I were to generalize the two countries, I would say that you could just look at the growth rate that you've seen in South Korea the last few decades, you compare to the growth rate of Turkey, it's just night and day. But when you peel the onion, like in Turkey, we only have one bet, and it's a great entrepreneur, and he's got great assets, and he's really smart about how he goes about his business and allocating capital and all of that. So I bought the existing pie at a ridiculously cheap price. But the issue is that the whole pie was like $40 million. And so, we couldn't put a lot of money into it. That pie is probably worth north of 500 million. So I think, but the other thing is that entrepreneur, he's a young guy, and I think he's got decades of compounding ahead of him. As long as he stays hungry and goes after it, I think he's patient enough, and the game will come to him. So I think he will make that pie grow. But even if he doesn't, we are just buying at such a discount, we're still okay. So we bought great assets at a great price. So my only problem with Turkey is I can't put 100 million into that stupid thing. I wish I could. In Korea, I think we are able to put a lot more capital. The pricing is not as extreme, but the pies are growing, and there's some great pies. And these are, I would say, like Munger says, you go fishing where the fish are. I think Korea is just a great market to fish. It's the Kospi's done nothing for 3 decades. Things are quite cheap, and the governance is getting better. The chaebols are losing power. All the factors are moving in the favor of the investor. So it's good.
Other questions? Yeah.
Sure. Eddie again. So you talked earlier about John Arriaga and kind of maintaining a small, focused circle of competence. You can find success there. But I think we've seen some examples of how you've maybe expanded your circle of competence to include opportunities that, like GrafTech, that someone sends to you, you're willing to expand your circle of competence to maybe understand that business. So I guess, one, how do you go about expanding your circle of competence and feeling very confident in that new, area within your circle of competence? And then two, is it important to be like a polymath as a value investor, someone who's kind of curious about everything and not super focused in one circle?
Well, I think you're better off. So I don't think one should be consciously trying to expand one circle of competence. I would say that investing is one of the broadest disciplines, because when you look at a GrafTech, you're going to run into a whole bunch of issues which you may have never thought about, and dig into those issues and try to figure them out and whatever else. So there's I think that if you're a curious mind and you're curious about how business works, what makes a business tick, then I think that you're going to understand, a few things that will lead to a good outcome. I mean, if you look at a business like GrafTech and you just study it from the perspective of a student of business, right? Not from the perspective, and that's how you should approach it, student of business. So if you look at GrafTech, there are several things. One of the things is that before Brookfield bought them, they had 6 plants. What Brookfield did is it took 6 plants down to 3. They got rid of 3 plants, and they honed in on a whole bunch of manufacturing efficiencies, and streamlined those plants and their cost structures and all of that. So they really kind of rolled up their sleeves, and they went to work on So it's not a business where they're just looking at huge tailwinds and just flying on those tailwinds. They actually went, just like with Fiat Chrysler, they went into the details of manufacturing to get efficiencies. And even like today, GrafTech had an earnings call. They have two plants, two out of these three plants. One's in Monterey and one's in Pennsylvania. Pennsylvania has been mothballed. They're just bringing it back to life. They are kind of moving some work from Monterey to Pennsylvania, and so they're kind of, it's about a 2 or 3 year project for them to do these movements. It doesn't increase capacity, but it definitely takes their cost structures down. And so this is a business that is doing continuous kind of blocking and tackling to improve their efficiencies and such. So I think the thing is that when you look at these businesses, don't look at them from the perspective of making an investment. Look at them as from the perspective of a HBS case study. Just a case is assigned to you as part of your MBA program, whatever else, and you study it. I think that's the way you should look at these businesses. And when 7 moons line up and it hits you between your eyelids or your eyebrows that this is a total no-brainer, that's when you should act. But beyond that, you should just keep reading and ingesting. And as you keep reading and ingesting, the circle of competence will gradually expand, and you will get there. And I mean, if anyone sends me anything on U.S. healthcare, I never read it. U.S. pharma, I never read it. Biotech, I never, because those are so far away from my circle of competence that I'm never going to get there. I mean, I think U.S. healthcare has so many forces that are non-market forces and that are such corrupt forces. I just ignore the entire sector, okay? Because I just think that once I get past, if I'm not operating in a sector with market economics, then it's just something doesn't appeal to me. So I don't want to look at health insurers. I don't want to look at hospitals. I don't want to look at all the different participants in the U.S. healthcare system because there's so many issues with it which are not market driven. That's like 1/6 of the economy, right? You can ignore 80% of the economy, 90% of the economy, still do well. So some areas I just don't want to read about because I know I may learn stuff, but I'm never going to go there. So I can focus on areas, I think it's worth studying the Amazons of the world, the Googles of the world, I think, because those are so much stuff happening in the world will, go through them, if you will. You may never make an investment there, but I think it's worth learning them, worth understanding them. So, yeah. Arvind, he's muted.
Yeah.
I have Mike here. My question is more general, and it's how much of your day is spent reading, and how much of that reading is based on companies that you own in your portfolio versus new opportunities?
Yeah, I mean, I'm looking at all the portfolio businesses, at least quarterly, because I at least look at their updates and stuff. And so one of the things about investing is that real change in businesses happens over years. It's not weeks or months, so it's really the timelines are a lot longer. And so you have to really kind of have an understanding that, it takes a while. And the new companies that show up, I mean, I get a decent flow of write-ups from people and such, and I look at them, but a lot of them are the stock's at 13 and they think it should be at 17. When I see that, I'm done. because I'm saying, okay, if the guy who's bullish on the company can't see a 3x or a 5x on the position, then what's the point? So don't send me stuff. It's at 13 and it's worth 18, please. At least it's 13 and worth 50. Someone's got to pay for, the shirt and the library and all that. And the 13 to 18 just won't get me there. We need some more meat on the bone. So, I look at those sometimes, they're in industries where I just know I don't want to go there. I think that today, I think someone had sent me some natural gas play where the most bullish scenario was about an 80x return. I didn't spend much time on it. Between us girls, it just looked like there was, that's a lot of that directional bet is on prices and all of that. So it was not, nothing was coming up from that made it obvious that I ought to drop everything and go all in on this. So I think you have to make judgment calls where you see something and you say, okay, let me spend 10 minutes on it. And after 10 minutes, you say, do I want to spend 30 minutes more on it? And after 30 minutes, do I want to spend 2 more hours on it? And you just keep making a call at each point. Next question.
Yeah.
Thanks, Chris. Curious. So you said you're willing to, you want to look for something that's going to give you a 3 to 5x return. How long are you willing to wait generally to achieve and realize that return?
Yeah, so 5x in 5 years is very nice. Even a 5x in 10 years, there's no problems with that. So yeah, so we can get those types of numbers. We're in good shape.
Other questions? Yeah.
One of the things that I struggle with is companies that have good earnings, but they have poor free cash flow because they have high capex. Do you like that scenario? Because I can see people liking it because they probably reinvesting their capital well. But to me, it seems like I like free cash flow.
What's the name of the company you talked about?
Micron.
Oh, no. I'm sorry. I thought you mentioned a company, but then you.
Micron's the one.
No. So I think what you want to look at owner earnings. Okay. You want to look at the cash the business generates that can be distributed to owners. Okay, after capex and after everything. So yeah. So and if Micron's on your mind, then at least for me, you have to wait some time. We can't discuss it today, but I would say that if I'm looking at a company like Micron, and capex is not a deal killer, but I definitely want to see what the owner earnings are after capex. Just because a business has high. So I agree with you. The best businesses are the ones that have no capex needs. MasterCard, or Amazon. These are great, or Google, whatever. These are great businesses. But you can do really well even in businesses where the capex needs are significant. The extreme case is I hate the auto business because of the capex. But even a crappy business like autos, even with, I'm not even talking about Ferrari, I'm just the mass market autos. Even if I take out Ferrari, Fiat still gave me a 4x in 7 years with all the capex and with everything else going on, right? So it wasn't a bad investment, and I think that the memory players, they do have high capex, but they also have high owner earnings. Other questions? Yeah, so you definitely want to look at the owner earnings. You definitely want to look at it after capex. And like I said, if you take the stance that I have a friend of mine in Singapore who probably wants to go unnamed. The guy won't buy any business which has capex. Period. You know, for him, what is very important is the incremental widget that they put out doesn't need any capex. You know, so he likes the Amazons, he likes the Apples, he likes the Googles, and he's done really well. So you can have a framework which says, I don't want to look at high capex businesses, and you can have a very comfortable life.
Other questions? Mohnish, are there any great recent reads that have that you've enjoyed? I know you read very widely.
Yeah, I mean, I think that one is that the book that just came out on Jim Simons, you know, the Renaissance guy.
Make it out of
Yeah, what's the name? I think the name is here's the cover of it, the dust jacket, The Man Who Solved the Market. Yeah, so I just started reading it, but the author, Greg Zuckerman, he's just a really good writer, and he does very thorough research. So, you know, he wrote a bunch of good books in the past. So I haven't finished it. I'm probably 20, 30 pages into it, but it is already captivating. So I think that's a good read. There's another book that I just ran into recently, which is called More from Less. It's a guy named John McAfee, and he wanders a bit. I think chapter 5 and chapter 7 has a lot of the essence of that book, but that book actually forced me to reset some thinking. So actually, one of the things that we don't realize, and I think many of you might be too young to realize that, but if you go back about 20 years and you think about, you know, all the things that we had in our life as kind of individual devices is all gone into the iPhone. So for example, you know, we used to buy cameras, right? Most of us don't buy cameras anymore. And we used to have like music systems and different nuances of music, and that's gone away. And we used to print everything. Like I used to print the maps and all that, and that's gone away. So a lot of physical devices that we had are all basically gone. Basically, atoms got converted into bits. And a lot of atoms got converted into bits. And we are seeing a lot of efficiencies come out in terms of usage of resources. So we are getting a lot of GDP growth without a proportional use of resources that we had in the past. A lot of it is because of the efficiencies, not just with the iPhone, but the efficiencies that have come about in manufacturing and in different industries and such. And so the book actually takes just a longer term view to show you that, and I think it's just a good kind of food for thought.
Got it. Well, Mohnish, this has been fantastic as always. Thank you so much for doing this, as always.
Well, Arvind, it was a pleasure, and you have a great class and some wonderful questions. So thank you very much, and enjoy the rest of the evening.
So thank you.